Welcome to the Trend Following Traders every Friday morning spaces get together um, from cold Florida. Kind of chilly down here. It's been chilly all week, 40s, 50s. Somehow figuring out how to survive. But I know it's worse from my friends in Virginia and New York. Not sure how it is around the rest of the world, but it's been a cold spell here in the U.S. with some snow. So that's nice. It's good. We need a little bit of cold weather, of course. It's winter. Um, so I can't think of too much going on in the markets this week. I mean, it's probably been a slightly negative week with the bond. Bonds are choppy. Bonds are whipsawing. It's no sure thing when you put these trades on. I was able to keep some short bonds, got long some bonds, so I have a mixed bag in that regard. Currencies, yeah, whipsawing around. Some of the commodities, pretty fun moves in coffee. Robusta, the UK coffee. I trade all three, but the Robusta in the UK has been the London coffee is by far. I mean, the other two are not even doing anything. So there you have it. Probably pretty correlated. If I cared, I would know, but probably pretty correlated most of the time, all the time, except recently. And the cocoa's had a big run up, a little give back yesterday, but cocoa has been like the trade. Long cocoa, short yen. That's all you need to do. Yen's going back down. Um, yeah, I think the long term trend following has kind of, not been that great, but I feel like that the whipsaws are minimized by the long term trend. So something to be said for that, I guess. I don't know too much about stocks. Stocks, can't think what the stocks have done, not too much. I had some good podcasts this week. Hope you listen to them. Hope we like to monitor the podcast out there, make sure everybody stays on the straight and narrow. Well, that's not going to happen. And especially enjoyed a couple of podcasts, Rob and Niels, and then Niels had another podcast with Global Macro Podcast, which I thought was really, really good, which we can get into after we hear from number one fan Oleg. Hello, Oleg. Oh, Oleg is requesting again. Add as a speaker. We'll see if he's ready. I don't know. I'll have to wait and see the technology here. Al, do you have anything on your mind this morning?
Hey, Jerry. Good morning. Good morning, everyone else, or good afternoon, depending on the time zones. So, I mean, at the moment, it is interesting to observe that there's a decoupling going on in the performance of my strategy, which is a short-term strategy, compared to the long-term one. But I think the main theme is the equities. Jerry Parker is talking about credit. He's talking about currencies, he's talking about commodities, but neither of them are the main theme at the moment in the market. It is whether you're able to trade equities. That's the name of the game. And these things have gone up since the 1st of November. So your performance is highly correlated how you're trading the equities and how is your performance going on there. And whether the equities continue to, go into the bull market, or some people are saying that it is a double top, it is going to come down. So there's a dependency. The performance is going to be somewhat correlated to what the equities are doing. And in my observation, every year is a dominant market type. In 2022, 2 years ago, it was credit. The short bonds were the main market driver, and there are always outliers, individual outliers that trend followers are able to capture, but the money is being made when those market types becomes established, and we make a ton of money from a diversified set of portfolio. So that's why this year is going to be interesting. What is going to be the main driver? Are we going to end up like last year, 2023? 2023 was mainly an outlier market. So different things worked on different times. It was quite educational for a new trader like myself. So, but I'm hoping that this year the market moves are going to be much more sane. I would say it's not going to change from equities to credit to crypto every few months, and things are going to stick around a little bit. So you know and credit is a big example. So since September, so I am short the bonds, long the bonds, short the bonds, and bonds are making money like nothing else on the short term, because it is whipsawing on the longer term time frames. It's not. It's an excellent trade on the shorter term, but it is still not the main. It's not the main return driver. What is the main return driver? Equity. So one of the key differences of trading equities is, there are lots of fun. So look around. Some people are giving a quarter of their risk budget into equities. Some people are giving 30%. Some people are giving 40%. I'm on the 40% camp, and Jerry Parker is giving more than 40%. So of course, it means that when these equities are doing good, your results are going to be significantly correlated with it. So, and this market type conversation, and usually we get into this, and longer term traders say that we don't have any parameters, we don't do anything else about the market type. That is true. So longer term and medium term strategies, usually these traders, these funds, don't have any parameters to capture the market type, but market type demonstrates itself in the P&L. When those, some people say sector moves, or the market type. So these are most of the time, similar. They refer to the similar phenomena, and this year, we are. It is good. This year has a big potential in terms of what's going to happen into the equity market as the interest rates are coming down. So we are at the moment in a phase as global economy starting to price these rate cuts, and as these rate cuts started to be priced in, trends are a little bit choppy here and there. Okay, this is what is happening in January, perhaps. But as we move along, as the Fed reduces those rates, then the European Central Bank reduces those rates. Of course, certain trends are going to be much more dominant, and we will be able to see those trends coming along. So so that's why I'm hoping that this year is going to be way better for trend traders across the board. So that's and that's what I'm looking forward to. It really more diversification, better trends, longer term trends helps. You wouldn't imagine like short term traders like myself when those established moves are there. It helps all the trend traders, and yeah, it's a very exciting year, I guess. And things started a little bit choppy, but that's, in my opinion, is just going to correct itself and give way to bigger and better trends as we move along from January to February to March and onwards. Thanks a lot.
Hi to everyone. Hi to everyone. Had a little, maybe even traditional program issue in the very beginning, and I want to say that I'm very happy to see you all here. And I would say that I like this idea. I like this idea of trading very different stocks. The idea of Jerry, first of all, that as Jerry said, that stocks deserve to be a 50% part of a portfolio. And I fully agree with this because it's really, I thought that commodities sector is the most diversified. And it looks so, but when I saw how commodities were going into one direction in 2021, I was rethinking about that. And of course, we don't know all the reasons of such correlations, and we must not know this. It's not our case. This why to know why. So, and I like, yes, really, when we are trading different stocks from different companies, it can be a very good diversifier. Different sectors, commodities-based stocks. So I think first of all, we must think about this being diversified, being a good risk manager, and following our rules. And of course, we don't know what this year will bring to us today or tomorrow, even what will be in the future. And Jerry says that the past isn't the best guide for the future, and I fully agree with this. But we take the main things from this. Our backtest, as Jerry teaches us, the main thing, trade stats, and having this knowledge, having these skills, we are in a very good situation as a trend followers. So I like this stocks diversification idea.
Stocks. I think that 50% trading stocks, 50% is, that's what's good for me. Maybe not good for everyone else. 20%, 25% sounds good. 40 sounds good. Maybe 50 is too much. But my problem, quote unquote, problem with the stocks and my portfolio of stocks is they're too diversified. I did too good of a job of creating a group of stocks that don't act like the stock market, which is not that difficult when the stock market is kind of dominated by 7 stocks. And the stock market is defined by the S&P, and what the majority of people say is the market. You don't even have to use the word stock in front of it. That's this little dig that they give at all of us who trade different currencies, commodities, and interest rates. But so I don't really, when I see my trades, the trades that we're going to do for the next day, I'm likely to see some stock buys and some stock sells. On days where the S&P goes down, I might be buying some stocks and vice versa. So my stocks don't act like the stock market. Now, that's over a week or two period, of course, or a day, or over short-term periods where the S&P is up a bit and down a bit. Of course, on really, really bad days, I mean, most every stock I have, except a handful, will be lower. And so on a daily basis, they're all influenced by the S&P. And if it's a dramatic move, especially. And I'm always having shorts on. I have a universe of stocks, and I take the trends as they come, and then boom, I get shorts. Well, the market's going up. Oh, yeah, well, that's the market. That's not Jerry's portfolio of individual stocks that he added in order to get more diversification, and even thought that the diversification from those stocks was so wonderful that he could trade half the portfolio in stocks. So it's it's quite a little conundrum there, but it's doing exactly what I'd hoped it would do. Not help me, some of the CTAs have programs and ETFs that half of the money is invested in the indexes, and so they really do get the stock plus managed futures performance. And I would say that I'll disagree a little bit with what Alp was saying, just under the context that his insinuation, at least the way I heard it and listened to it, was that he was sort of insinuating that, well, we're just headed for lower rates. I mean, that's just a given. So what's going to happen, in conjunction with getting these low? Well, I don't know about that. I mean, are we? I don't know. This is why we trend follow. Like I said, if you look at what is happening in the real world, I got long a bunch of interest rate markets, and they've sold off quite a bit this week and last week. I luckily was able to stay short U.S. interest rates for the most part, and they are then they have reversed and started going down. So the jury is out. Another thing I wanted to mention too is, I didn't mean to be a jerk about this, but I read some of these posts that people make about trend followers, and I think a lot of them are directed at me. They're digging at me a little bit, especially the people who know me, and I've had situations with before, but there was one where Mike said something about trend followers use regime. It's all about using regime filters. I have no idea what a regime filter is. I Googled it. No, I used ChatGPT to figure out if what a regime a filter would be. And I don't know if I was able to figure it out. It seems a little subjective, but yeah. So I think that the whole point is we don't use those sort of things. We just use these trends, and I don't really. I posted something yesterday about all these people thinking that making all these predictions and guarantees about the interest rates and where bonds were going, and now it's just the time to get long. I mean, everyone knows it. Okay, I mean, if it turns out to be true, I'll be probably fully long, no diversification, unlike my stock sector, because that's the way bonds have been over the past few years. 100% short, maybe we're headed to 100% long. But at least right now, it's somewhat of a mixed bag. What do you think, Al?
Well, I mean, this regime filter thing is something else that I do not use. But, so some traders love to go long stocks only. And when you go long stocks only, there are regime filter, and there are many ways to implement the regime filter. Some people implement it from fundamentals. Some people implement it using technicals. Like the classic example is, when price hits 200-day moving average, you only take longs, and when the price is less than 200-day moving average, then you only take shorts. And you may want to ask this to Michael Melisianos, but I'm under the impression that he was tweeting something else similar to that as well. So maybe he's doing it, maybe not. I don't know. But there are lots of traders who would want to prefer the equities like that, the single name stocks like that. So some traders love to use just long only, so they only take the long stocks when the S&P is above 200-day moving average, and completely disregard everything else. And so that's one way of using this regime filters. The second group is very common in the crypto space. In the crypto space, people trade regime filters. This time they don't use S&P, but they use Bitcoin. So they swap Bitcoin for S&P, and they think the crypto space is in a long market when Bitcoin is above about 200-day moving average or another moving average. Let's say some people might be using 50-day moving average, and so my trading is not like that. So I'm aiming for the minimum number of filters, and I've never seen anyone else using less filter than myself in terms of trading. So I'm a big proponent of getting rid of all the filters to the extent that it is possible, and and there are another group of traders who would like to filter out the VIX, the volatility index as well. So that's another regime filter. So you got VIX. When the VIX goes up, they stop trading the single name stocks, or they exit even. And so what happens is, of course, because I'm an outlier hunter, so I'm trying to get those big winners. Usually these are 5 to 10% of my portfolio. And the risk is, if I stop taking these trades, then I might miss a big winner, a super performing outlier that I'm going to catch. And because of a volatility filter or because of a regime filter, then I might end up losing it. And that's a big risk. So, instead of so I basically completely disregard these market regime filters, either on the volatility side or trading on the Bitcoin or trading on the S&P. And of course, you can use this idea to think about other defined markets. If you're trading USD, there is a USD index, for instance. You can use it as your basis for market regimes. And there are some other traders who are, comfortable to use, fundamentals like interest rates. So interest rates could be seen as a market regime filter as well. So there are different ideas about, how to use this, but it all comes down to filtering out, the filter banks, having a defined filter bank, having a defined set of filters like 7 or 10, or some people are famously have 20, 30 filters and whatnot, and they would like to add those filters. And this just doesn't go with the trend following that I'm applying. That just doesn't happen, because if I miss a trade, then it might cost me my year. So I cannot afford to miss a good opportunity and a good trade. So that's why I'm trying to implement as less filters as possible and try to avoid any sort of market regime filters. Yeah, I hope that helps. Thanks a lot.
Yeah. Yeah, that helped quite a bit. I mean, now I know exactly what's going on here. Um, yeah, so you don't want to use those. The only good filter, and filter used to be a dirty word, and it should be, because if your filter prevents you from getting into the trade, you don't want to use that because you're going to miss some outliers. And filters are okay if they improve your trade stats. For one, they help you take fewer losing trades, which is possible. And then, but the 100-day high has fewer losing trades than the 50-day high. So you sort of see that, okay, but the 50-day makes more on some trades than the 100-day because it gets in quicker. So there's all kinds of ways we're already using that type of strategy to filter out all of the trades. We don't want to trade all of the trades. We want to limit, as Richard would say, the ones that are that are in this range where something's going on and you may get a big outlier, and that's these long-term breakouts. So you don't really want the filter is okay if it slows the trade down, essentially. So like you could have a filter that says, okay, I'm not getting a good signal here because this filter hasn't been satisfied, but part of the mechanics of the filter is it will not ever prevent me from eventually getting in the trade, and not in a week or two or a month or a year, but pretty soon, within days. If the market continues to show more strength, for instance, this filter kicks in, and I just bought at a slightly higher price. And so I think those things can work. I've seen them work. I might even use things like that. It's pretty uncontroversial. But another thing too is I understand, this. You mentioned something earlier about sector approaches, and you and I are hunting outliers, and so we trade these markets, and they belong to sectors, especially the currencies and the stocks and the commodity and currencies, bonds, and stocks seem to have these sector moves. And we've seen it in the dollar. We've seen all the currencies go down versus the dollar. We've seen all the bonds go down. It's sort of a big, huge sector move. And at the same time, we're all hunting outliers. We can't help but make money in the sector moves as well. So you get these regime filters, is what you call them, and I have heard of people using them, not kind of using that name. I thought regime filter was some sort of almost discretionary fundamental idea that you had that, okay, now's the time to go long bonds. But I think that there is a problem. There's just not an opinion. There has to be a problem, mathematical problem with these regime filters. And basically the problem is that you don't, it's not going to help your sample size and make your system better, more reliable, to look at something other than each individual market's price. So you're looking at one entry, one exit, and a stop loss. Jerry's already defined that as the perfect way to trade the markets, but that's got to be applied on each individual market. You don't want to make your signal in the British pound contingent on what's going on in the dollar index. Number one, that will reduce your sample size, and then it won't test out as well. The back test will not, at least in mine, it won't, you know, maybe if you have an incorrect your back test is not that great, and maybe it will test out better. I don't know, but for mine, it certainly won't test out better. You're not going to get anything that tests out better than applying the one entry, one exit stop loss to each individual market. And it strikes me again as just a misplaced idea, because it's like this huge emphasis and concern with taking a loss. Oh my God, I have got to make sure the 200-day moving average on another market or another index is positive before I can dare uh, so the regime and the sector, I'll get this um, extra confirmation. And I'm sitting there going, dude, put the trade on at the breakout. And if it goes down, lose your 12 basis points or your 20 basis points. Where's the asymmetry here? Where's this anxiety over what if I put on a trade and it loses money? Oh my gracious. Diversify, put on longs and shorts, trade really small bet size, and put the trade on. You want to sit back and hem and haw about it. And then all of a sudden you got a 50 ATR trade that you missed in a system that's not very robust, and all because you didn't want to risk 25 basis points. You didn't want to lose 25 basis points. Man, I don't want to lose it either. But you got to get your priorities straight. And so, but the bottom is it's not going to test out as well.
I agree with Jerry that I think that these filters, they can make our strategy less robust. So a lot of filters. I don't mean all the filters, but the main problem is that it will be a catastrophe maybe in our trading if this filter will filter us out from the big trade. And maybe it's not a problem like Moritz said, that it's not a big problem to to make a lot of different strategies, filter-based strategies that are complex and that maybe work, but the problem is it's fragile. In the end of the day, sooner or later we will face this situation when our system is less robust and fragile, and it's very important to understand. And so we must be cautious with all filtering, I think. And our transforming strategy is organized in a such way that we have really our maybe we can call it naturally filter or something like that. That our signals they made in such way they works in such way that we have an effective optimal trading. So we maybe some filters maybe look good, yes, really. Oh, but for me personally, I have made a lot of back testing with filtering, and I saw that maybe in 2017 it was perfect, in 2018 it was not so perfect, and for example in 2019 it was worst even than to trade without any filters, and so on and so forth. And I have seen a lot of this. So first of all, we are risk managers in our trading activity, and I think that it's all also part of risk management to use to this picking up these filters. I think it's part of risk management. Wide, if we look at this problem in a wide way, so we manage risk using such things.
So I wanted to get into some of these podcasts that I enjoyed this week. Like I said, Niels had on this guy, David Dredge. I really like this guy. I've heard him before. I've heard him on Niels's podcast. He's really interesting. Honestly, I can't remember, or if I don't know if I understood exactly what kind of trading he does. I know it's probably something based on vol and on options maybe and outliers to some degree, but I really couldn't don't remember that being a big part of what he was talking about, his actual ways of trading. But he had a couple good quotes, and I posted them, and I really liked them. because they agree with kind of like my philosophy, I guess. I guess that's why I liked it. But okay, here goes. The biggest flaw in the financial industry, he calls it sharp world, is that there is not a metric or an incentive for compounding. The end objective of the capital owner should be terminal geometric compounding. That's ignored by the industry and the Nobel Prize winning mathematics and academia. That destruction of compounding is the destruction of wealth. It's literally a transfer of wealth from savers to the financial industry. It's not the frequency of the monthly returns that matter. It's the magnitude. So he sounds like a outlier hunting trend follower. Um, and even Neil's kind of on his podcast with Rob even mentioned that a little bit of he was in agreement with all of this, which I think I don't really understand because that really flies in the face of dynamic position sizing and vol and correlation management. But yeah, I think that's very interesting from this guy to sort of complain about how everyone is sort of using volatility as risk management or as defining it as risk and paying attention to sharp and how much money they're leaving on the table by not letting those profits run. I think that, as I've said before, though, um, they just don't get the money management right. And the idea that you can't use the current equity and keep leveraging up that current equity to compound open trade profits that if you're letting them run, you're going to be very, all over the place. That's why I think to some degree they feel like, well, we can't let them run. Yeah, they can't let them run because they're doing something incorrect on the money management, which is sizing the trades based upon including open trade profits, which go away. They fluctuate wildly versus the closed trade equity, the realized capital in the account. In order to, if you use that, you can embrace the let profits run and take small losses. So it's kind of a mess that they're all in. And then plus, we also were joking around on Twitter about how you can't deposit sharp in your bank account. And then I said, well, I kind of disagree with that because if you pursue sharp, you're going to have more assets under management and more management fees. So you're going to be able to deposit that. So that's another thing that there's a handful of reasons to not let profits run and to live in this sharp world where everybody just pretends that the best way to manage money is to manage that volatility of hugely profitable winning trades versus optimizing for the outliers and allowing them to run because that's what the computer says makes more money. I really, really enjoyed the Rob and Neil's. Someone wrote in about single stocks, trading 500 stocks or hundreds of stocks versus asking a question of what they thought about this versus trading the S&P. And Rob made some funny comment like, is that Jerry writing in under a pseudonym? I thought that was funny. That was pretty humorous, right? Okay, so Rob gave a great answer. And he said, trading 500 stocks versus the S&P creates the opportunity to trade 500 different instruments, and that gives much more diversification. This is especially true when correlations are not a good measure of the nonlinear outliers you can get from trend following. That's right. So maybe some of these stocks are sort of correlated. They're not as uncorrelated as my group because of the way that index is constructed. Those stocks would be more similar, but still, he's sort of saying like, hey, you're going to get these nonlinear outliers, and the diversification numbers that you run when your traditional diversification measurements may say, you don't need to trade all 500. I mean, trading all 500, especially long and short, is going to give you more diversification, more outliers, better performance than trading the S&P alone, of course, with your trend following. Which, think about it. I don't really know if that's even a legitimate thing to trade indices with trend following because, we've talked about that forever. But then you're going to mess up this whole idea that you're going to have these outlier trades and you're going to miss some of them if you rely too heavily on correlation. Then he goes on. Oh, this is Niels talking. So Niels is talking about Dredge in his interview with Dredge, which we just talked about. Great guy. We need to optimize for outliers and divergence. Wait a second. Is this Niels talking? Yes, it is. Should we be scared of the occasional time where our systems get a lot of conviction in our positions, or should we welcome it because that is where the big performance might come? Too many people are optimizing their portfolios and systems for the mean performance. I mean, I don't know if that's Richard or Niels. Sounds a lot like Richard, but of course, that's exactly what we've been saying for a long, long time. Let these outliers go. It's this, not paying attention to sharp, not paying attention to the volatility of hugely winning trades, parentheses at the same time, um, protecting your capital, which our style of trend following really does. It's like a superpower. I mean, you have, what can get you? You have this big, huge profit out of the 100 markets that you're trading, and it had a big run up, and then your long-term exit didn't get out at a great place. It gave back in your mind way too much profit. And then you're like, oh, that's really horrible. Well, your capital hasn't been impacted at all. Your trading size, which is based upon that capital, not that open trade profit. If you would have gone out and done the wrong thing and used your open trade profit to size to more new trades, or recalculate the position sizes on the old trades, then yeah, you would be in some trouble. So you got to vol manage, and it's just a morass. It's just do one thing wrong in life, do one thing wrong in your plan, then you're going to have to continue to do wrong things so you can survive. Harsh words.
In terms of trading single name stocks, I mean, I've noticed that the differences among different traders are starking actually. So first of all, managed futures CTAs are not trading single name stocks. So yeah, I mean that's really not that's really not making sense. It's just you're ending up with lower returns and less diversification when you do not trade single name stocks. And it's a little bit, sometimes Jerry Parker talks about Stockholm syndrome, loving your captures too much. Is a result of that. These people, these traditional portfolio holders, are giving you 5% of their allocation. So you're saying, okay, I get this allocation and I'm going to accept lower returns and lower diversification by not trend following single name stocks. It's just, and there's a big $400 billion industry called managed futures who does that. So it's unbelievable what the game of money management has reduced into. And there is apart from this group and Jerry Parker, to be honest, there's no one else actually comes and says that, hey, you're all doing it wrong. It's just wrong. You have to trade single name stocks. And it's unbelievable. It's unbelievable people even do not embrace change when it comes to trading single name stocks. So that's a big thing there. So that's one big dogma there, a dogma that needs to be broken down into. You're gonna trade single name stocks. They're better diversified. They are better return drivers. You capture your outliers, and you do have these properties whether you have dynamic position sizing or not. So whether you do have dynamic position sizing or not, single name stocks just provide you better investing options. To be honest, it's just starking. Unbelievable.
You're making me laugh. I mean, I'm laughing the whole time you're talking because it's really funny. Yeah. So, not to pick on Niels, but, they keep talking about this, and Rob is laying out a good explanation. Of course, it's just pure logic. And I think sometimes when they're not kind of dealing with Rich and me, and we're not part of it, they're just left to their own devices, and they hear other people ask questions and talk about it, you get a much different answer. Like, I feel like when you get into these arguments, people go to their corners, and the discussion is not that reasonable and interesting because it's just defending your position. But this podcast was particularly interesting because they, in my mind, they got off of their position and went over to our side. And however, at the very end, and Rob says he would trade all these stocks, hundreds of stocks in his portfolio if he had a bigger staff and stuff. And he came up with, you should listen to the podcast. It was really good. He came up with a lot of issues with stocks about not only how they differ from commodities, which is how I kind of would have worded it, a few hurdles. He made it sound way harder than it is, especially given the fact that all 90% of trend followers trade stocks only because it's small retail people. And 99% of people who of the assets under management and trend following strategies don't trade stocks, but 90% of the traders do trade stocks because 90% of them are small retail people who are just using their version of trend following. So it's not insurmountable, even though he kind of tried to tilt it that way. It's not true, but and this is stuff we've talked about before. But because then the next conversation was, I don't know how. Maybe trading all these stocks is a good idea. I don't know. Maybe you don't need to trade all these stocks. Maybe trading the index is as good or better. We don't know. I need to see a back test. I need to see evidence of this. So here you have this one little sector that everyone loves. That's the most popular sector out there, the stock market, being held to this much different standard. Can you imagine coming up to any CTA and saying, I don't know about trading all these currencies that y'all trade. I don't really know. I mean, I don't know. Do you get more diversification than the dollar index? I need to see evidence of this. I need to see a back test or the commodity index, So all of a sudden, they all trade as many currencies as you could imagine, all the commodities as you could imagine, because they're so wonderful. And the bond markets, they don't just trade TLT or a couple, 2 or 3 to get, some people do, but a lot of the CTAs trade long-term, short-term, medium-term interest rate markets. They probably as many as they can probably get their hands on that provide enough liquidity all across Europe, Asia, and the U.S. and Canada. And but now if you're going to mess with us and talk about these individual stocks, well, now we got to have a serious conversation. Not any sort of criteria or we would apply to any of the other markets that we currently trade. Oh no, but these stocks, they deserve this incredible scrutiny and the silliness of, I wonder if more diversification by trading the individual markets is going to be better or worth it. I need to see this back test. Yeah, fucking break. Come on, man. This is how silly it is, And I didn't even tweet that part because at some point I just get tired. And yeah, I mean, but I do think that it's great to have that back test. Don't get me wrong. You should back test everything and don't shy away from it. And what do we have? Because obviously, but is going with the trend, is that a good idea? I need to see this back test. Is taking small losses. All of these things never are questioned. They're just given for the CTA industry. But trading stocks for your clients is going to make your performance better. It's a hassle. And it doesn't fit with managed futures, as Alp was saying. Managed futures works a certain way. Allocate 5 or 10%. Futures only. Crisis alpha. You're on this planet to serve traditional portfolios. And to the degree we think you can, we'll allocate 5 or 10%. But basically, you can turn your trend following strategy into a more perfect portfolio than anyone else has to offer because it'll have the stocks and the bonds, but better long and short with the trend following strategy.
Now, the second interesting point about trading stocks is, there are a lot of traders who love to trade the US equity market. Everyone else is comfortable to trade NASDAQ, S&P 500, Russell 1000 or Russell 2000, or even sometimes the components of it, the single name stocks. But when it comes to, Chinese stock markets, it is really, it is really difficult to see as someone else mentioning on his posts these tweets saying that actually I'm short Chinese stocks. It's really people are really trading the indices. They are trading you know Japan indices or Chinese indices or Asian indices, but really, the, the number of traders who are doing the work to trade the single name stocks, the Chinese stocks especially, is really rare. So there is some value to be added into, and it is possible to trade Chinese stocks. For instance, in the UK, there are more than a few brokers who provide access to Chinese stocks, and they are great diversifiers. And I've just recently started to incorporate these things into my back tests at the moment, and the results are starking. So really, you're gonna say, why you're not trading Chinese stocks? And people come up with different excuses, like they're emerging markets. Some people say that U.S. stocks historically in the last 200 years have this sort of a performance. Is back tested. It is documented. So trading U.S. stocks is the golden rule. It is the dogma. It is the Bible. So you have to do it. This is this is the way, and it is either my way or the highway. So people are very cut and fast about trading US stocks, and they don't want to be taking much risks about Chinese stocks. Who would trade Chinese stocks, right? Richard Norgate Data is on the call, and his firm provides lots of stock information, single name stocks, but they provide it for Canada, Australia, but definitely they don't provide it for Japan. They don't provide it for China. So it's really, when you look into it, it's possible to find the data. It's possible to find the brokers who provide access to these single name stocks, but people just don't do it. And that's the second most important aspect of it. What is your strategy in terms of diversification properties of international equities? China is a huge competitor in terms of economic power to the United States, and there are huge diversification benefits to Chinese stocks, and they're all in a downtrend. Have you heard any long-term traders saying that I am short Chinese stocks and they are making great money in the last 2 years? So where are they? So that's really the second point that I would like to emphasize. Who's trading those Chinese stocks, and when the market turns, obviously, when the Chinese market at some point they're going to recover, maybe next year, maybe I don't know when, but at some point Chinese stock market is going to come back, get into higher highs and into the bull market, and then they will be even better diversifier to the U.S. equity market. So there is huge potential in adding international equities, and within international equities, I'm a big fan of adding Chinese single name stocks. So that's the second part. That is, there's a huge divergence in terms of investment strategies and how you are trading the equities. And the third one, the third difference is mainly coming on, so there are some people in the Twitter space that you always see, and there are some people that you really respect and have great careers, but what they are saying is just too risky. Let's give an example. Mark Minervini posts in Twitter space quite a bit, and he says, I made my most money by trading 4 or 5 stocks, and he promotes risking 20-25% of your assets into a single name stock, and that's another difference that we do have. So I'm trading 75 single name stocks. They are pretty much leverage controlled, and I'm not planning to make a lot of money on any of those single name stocks. So the other difference is, these there are some people who think that you can actually select the best winners and just, I think, Mark Minarini is following up the O'Neill, lineage, and it's a very, respectable trading lineage, and they do follow, a certain method to madness, for sure. But when you put your money into 25% of your money into a single name stock, even that stock might be Nvidia, one of the best technology firms with a market capitalization of $1.5 trillion, and Nvidia, breakout is going higher highs at the moment in my portfolio. So I'm quite impressed what that stock is doing. But still, I wouldn't even contemplate on putting 25% there. So that's the another thing. There are some career stock traders who think that you're able to put a lot of money into a single name stock, and so these people even do not even contemplate on investing into Indian stock market, Chinese stock market, and these become really the big dogma. Everyone else is trying to make the big bucks from U.S. stock markets, and some people are very limited in terms of their diversification opportunities. And if you're trading a small set of single name stocks, then of course the chances of a catastrophe, you're hitting a big gap, or something going wrong, increases significantly and puts your portfolio into a huge risk. I hope it makes sense. Thank you.
By the way, I like how this geographical diversification across stocks, across geography. Also, I like this because the more diversification we have, diversification parameters maybe, the better it is. But we must know, I think, all the details. I mean, all the costs of this stock. So I think all the details of this trading. And of course, I think it's interesting idea.
Yeah, I'm going to change my mind from my diatribe from last week. I do agree that in order to pursue fully diversification, it probably is a good idea to, if you want to have like a certain sector or industry in your portfolio, then don't make it all U.S. or Europe. Find some China or India. And I'm going to disagree with what I said last week, which is I don't think that's so important. I do think that that is obviously something that could help out the portfolio. And I do that in my portfolio. I have non-U.S. companies, in industries and doing things, businesses that I could easily replicate that with a U.S. company. Um, so I think that that is a good idea. I think shorting stocks individually is um, difficult. It's difficult in the U.S. It's probably very difficult in other places. IB probably makes it easy for most people, easier than as easy as can be for most people, but still obstacles to shorting stocks. I would say though that it seems to me I'm not an expert in this, but I'm an expert that life kind of sucks, and I think that the idea that when you break down the issues and the cost as it relates to um, trading stocks, that you somehow think magically that all of those issues go away if you just do the index. Where my guess would be is that those costs and issues are sort of built into the index. If it's tough to short stocks individually, does that fact of life, the fees and the interest, does that have anything to do with the price that you get when you short the index made up those very same stocks? So my guess is probably you can't really get rid of those problems and those costs. You just don't see them. You know, it's in your FCM account. It looks like all the other futures. You're just so happy, ignorantly happy, and you're selling this. And certainly this is so far superior to any of the selling the individual equities, maybe, but probably not as cost free and easy. It's certainly easy operational to just sell the index, but not sure about that. There is some of the cost of trading stocks and shorting stocks are not passed along effectively into the index as well. And then trend following. I don't think it's necessarily and I've heard people say this, but I don't think it's necessarily a component of trend following. Trend following needs to trade a lot of markets. I've heard that a lot. Trend following needs to trade a lot of markets. It's trend following is the issue here. And trend following is so wimpy and weak and fragile and kind of hard to deal with that if you're going to do it, you've got to use a lot of diversification. All the four sectors, fifth sector, maybe crypto, long and short, and cross your fingers and hold on because trend following is just so horrible. I don't really think that's the case. I think that's a misstatement. I think a lot of the strategies need any kind of strategy, especially if it's systematic, needs a lot of better diversification, more diversification. It's going to make things better. And but that doesn't mean a lot to some people who kind of are in a different category, different strategy of you're going to, you need to find the right markets. And trend following says, I'm trading all these different markets. I have no idea which ones are the right ones at the right time. I'm just going to put them all on if they look like they're moving higher or lower. And if not, I'll just take a small loss. So I'm going to have 60% losing trades. I'll hit those outliers like everyone else did, but I won't put myself in a situation of the type of risk and loss that you could have in a way more concentrated portfolio.
Okay, so we've already discussed about three main differences. I think on my list, the last difference is is another big one, which is long only equities. Long only equities versus like myself, I trade short single name stocks, and there are some very reputable and famous traders that are doing this for decades who actually managing funds and whatnot, but they only do long only, and that's another big difference. And in my back tests, trading short single name stocks are adding value, and also it is one of the hedging techniques. So diversification is a hedging technique, and it is cheaper than buying put and call options. And going single name stocks short is also another hedging technique, because there are not many people who actually backtests to 1929, to the Great Depression, on the days that the Fed didn't exist and whatnot. But it doesn't mean that we're not going to have another major catastrophe where shorting stocks are making a lot of money, and especially V bottom. So when we do have these V bottoms on the equity market, like 2020, this COVID, trading these single name stocks short are making a lot of money. They are making a lot of money. So on the moment that you are not trading short these single name equities, you're saying that I am not going to make any decent returns when there is a COVID like event is happening, quite black swanish, quite quite a catastrophe, quite chaotic. So you don't know how these events are going to hit and when, but when they are here, for sure, for better diversification, so to be able to smooth out your equity, trading single name stocks short is a better choice than doing dynamic position sizing. It just helps better. And again, going short indices that do not provide that much of diversity, because you only have 20 or 30 indices that you can actually short, or maybe 50, but you're actually competing with tens of thousands of single name stocks to be able to short to, and there are costs around it. Yes, but so this time you get the funding charge. So you're not actually paying the funding charge, but you're getting paid the funding charge. You pay the commission. It is operationally difficult to be able to trade a lot of single name stocks, and sometimes to be able to borrow the stock adds additional costs to it as well. So there are some drawbacks to be able to short single name stocks, and you want to keep the leverage low because these smaller companies are getting acquired and whatnot. But overall, after all these hurdles, if you're able to add these single name stocks into your portfolio, adding them short adds a lot of value. I mean, it just happened to be the case like 4 years ago with the COVID. So you wouldn't want to be missing this diversification opportunity, and I believe that is very, very critical. At least the way I am running my trading program. Thank you.
Seth, I don't know if you want to talk about. Oh, maybe Seth just left. Did you want to talk about the trends in Bitcoin and crypto, or I guess they've been selling off this week, but hopefully those trends stay intact. Marcel, this might be your first time speaking on our X.
Yes, it is.
My friend from that I saw in France, my friend from Romania that I hung out with in France this year. What's going on?
Hi, I'm fine. Hi, everybody. So I'm using region filters, like Alp said. So yeah.
Okay, Marcel's shy. Steph, how are you this morning?
Hey, good morning, Jerry. I could actually hear Marcel speaking. I don't know if anybody else could, but I didn't want to interrupt him if he's still talking.
Oh, I'm sorry. Well, why don't you take off and let me hear what you have to say. Then, when you get done, I will fix my iPhone and so we can hear Marcel.
Roger. Well, good morning, everybody. Happy Friday. It seems the spot Bitcoin ETF launch was a bit of a flop as far as expecting the big price move that everybody was hoping for. But it seems like Ethereum has taken the opportunity to try to make up some ground on Bitcoin, which is good. I'm long both Bitcoin and Ethereum futures, and just kind of slightly profitable in both of them. And it crypto is just doing what crypto does. It I think it does what most markets do, and it tries to trick the most amount of people it can into and doing the exact opposite. But just like every other market, you just stay in as long as your signals are telling you to stay in, and hope for the best. I saw a couple of interesting tweets this week. One kind of in line with what you were talking about earlier about Sharp and about the industry is really set up not necessarily to make customers money, but for managers to be able to capture uh, fees. And talking to it was on Ben Hunt's podcast specifically, but he was talking about how um, the difference between carried interest and management fees, and how management fees really eat away at the client account and benefit the manager, and how performance fees really make a lot more sense, where the managers make money when the client makes money. And I know that's how a lot of the CTAs do it, and it seems to be a good way to go. You got your little bit of a management fee to keep the lights on when things aren't going well, but when the client does well, the manager does well too. That seems like a fair way to do things.
Okay, Marcel, maybe I can hear you this
Yes.
time.
Hi. Yeah. Yes. I'm hearing you. Thank you for inviting me. So I was saying that I'm using regime filters also for equities and also for cryptos. Yeah, like Alp said, exactly like Alp said.
I think, yeah, like I said, I think that whatever you use or whatever you call what you use, I think for all of us, I think, one of the things that you just want to be careful is don't get in a situation where you're going to miss a trend. I think I don't really believe in these perfect setups, patterns, and so that in trying to increase your accuracy at the expense of missing an outlier trade. I think what works best for me in my 40 years has been sort of the opposite. These parameters and systems that are very crude and they catch everything, they catch all of the trends, and they look pretty dumb sometimes because you're getting in trades that are not going anywhere, and then you're taking all these losses, and then you're giving back profits at a sort of an alarming rate. But of course, everything we do for all those years has been based upon a back test, and that's kind of what the computer says: is that avoid precision, avoid perfect setups, regardless of what that is. You want to take the A trades, the B trades, and the C trades because the C trades will contain outliers that will really make a lot of money for you. So I think that's the danger. No matter how you do it or what you call it, I've missed my fair share of outliers for multiple different reasons, and it's no fun. And it's in any approach that, at least from a trend following perspective, that is possible to miss an outlier. Even if I have definitely seen a research and heard people talk about backtesting, where and I think I can quote what they were saying. It would be something like, "Yeah, you may miss a trade in this particular situation. You may miss an outlier, but it doesn't seem to matter." And I think that maybe that's true, but I'm too afraid and too conservative to put myself and my clients in that situation where I'm going to miss a big trade with increased precision and focusing on not getting in at the exact right time or not taking a loss.
Yeah, actually, I miss some with the filters. Yeah. Yes, I miss some. So, thank you.
Jerry, would you like to speak something else? I would like to talk about a little credit trading and how it is going. Do you have some? Is that all right?
Sure, go ahead.
All right. So, in terms of credit trading, I mean, the long dated. So, I'm trading long dated, long maturity bonds specifically, like 10-year, between 10 and 50 years. So there's 10-year notes, there's treasury bond, there's ultra. Okay. And with these ones, one of the benefits of trading these long dated ones is, the leverage is manageable. So it's nothing like trading short term interest rates. And the movements, the price is less correlated to the Fed's fund rate. So when something else happens like 1987, if these Fed funds rate or interest rates in EU, in Japan, or in US, if they go up or down, then surely the impact is going to be less to the long dated bonds. So there are some advantages in terms of managing risk and managing volatility and whatnot, just focusing on the longer end of the curve. So it is kind of helpful. But what what I have surprised to see is, now I'm trading those short-term trend. So the definition of a short-term trend for me is anything else between 0 to 4 to 5 days. Okay, average duration, and anything else, any average duration more than 4 to 5 days, I define it as medium term, and anything about 6 months goes to the longer term. So with that thing in mind, these credit trading, I mean, I'm calling this period as the age of credit trading. And, more experienced traders like Jerry Parker can surely give much more flavor to it. But I am quite surprised the volatility of those bonds, these long dated bonds, these treasury bonds, this ultra bond, the European counterpart of it is just, both European and US bonds. They are very volatile. They are going up and down. So, in September, my system has made quite a bit of money just by going short. And then I made this time another sort of good returns by going them long in November and December. And now I'm still in the money, not a lot, but still in the money, this time going them short. So, I'm not quite sure, are we experiencing a sort of a character change in the credit trading, or whether credit trading has been so much emphasized in the past back tests and how you're using in your back tests, for instance. But I'm finding these things are, very good return drivers. They add quite a bit of diversification, and quite shockingly, they are making money, and long and short. And the volatility of these things, these instruments, these markets are actually quite striking to me. And you would, I wasn't expecting to see that much of a volatility in these instruments. They are pretty much part of this 60-40 portfolio. 60% of stocks, 40% of bonds, credit instruments. So there's always these things supposed to be much more slow volatility, low volatility, diversifier to the portfolio. But at the moment, the volatility is up, and sometimes they are correlated to single name stocks. So in November and December, there has been a huge correlation, positive correlation to the single name stocks. And at the moment, uh, you know, depending on how your equity portfolio is doing, I think still you can say that equity indices has come down a bit since December. So and these long dated bonds as well. So there is still positive correlation still going on between stocks and bonds. So it is quite interesting. So that's why I'm calling this thing the age of credit trading. I mean, is this phenomena is going to stay? Are we going through a period where credit trading is going to be much more emphasized? So these are the questions that are on my mind. Thanks a lot.
I did post this one other thing I thought was a pretty interesting article about commodities. Oh yeah, it was about why that group is attacking the shipping, and I thought this was a very interesting article. It was on LinkedIn actually, and the title of the article was "Why Attack Shipping." The Houthi strategy looks primitive to most, with the random attacks on ships sounding desperate and quite elemental in a world of AI and space exploration. But the game theory behind it is superb. Bulk commodities like oil, coal, iron, ore, etc., can adjust to disruption as they are mostly fungible. Disrupt the east west corridor for finished goods, and you have leverage because prices will react positively, and there is no adjustment path anywhere else. Okay, I don't know about that. I didn't really understand, probably don't understand that totally, but I think what I took away from that was minimally, trade your oil, coal, iron ore, etc., which we do. But don't discount the stocks of these companies that could be impacted. Their finished goods can be impacted. And I think, because I know I've heard CTAs say negatively that you're not going to get the type of exposure that you would get in the basic commodity futures that in the stocks, commodity related stocks. So the oil companies, the coal companies, the iron ore companies, you're not going to get the same performance. Well, Granted, you're not going to get the same performance, but you could get different, sometimes better, sometimes worse. And I think this is just giving me an indication of, keep doing this stock thing. And I like to trade stocks that are involved in the commodity business. A lot of our companies and stocks are involved in the commodity business, but it's no guarantee. But I do think that you get a different performance, and we've seen that before, where in a lot of the commodities they had much different, sometimes worse performance, worse trends, crashing trends, and the stocks related to those commodities kind of hung in there better. So I think that's another kind of good reason to be hopeful that you'll pick up some different diversification, some diversification, some different diversification when you're adding the single stocks and curating your portfolio of stocks in a way that you're really putting an emphasis on finding diversification and not trying to replicate those 7 amazing companies.
To those of you who do trade single equities, long and short, how do you incorporate the borrowing costs into your back test? Is there a good way to do that, or do you just estimate it, or is it just kind of something that you just deal with once you're doing it live?
Well, I think a good way of looking at it is to trade those stocks that have really low borrowing costs, and that's what we try to do. You just don't trade the ones that are very expensive. Yeah, so there is a lot that goes into it. You've got the borrowing costs, the borrowing fees, and then when you then you pay the dividends. You have to pay the dividends back. But when a dividend is declared, the stock that you're short goes down the amount of the dividend, and then you have to pay that back. So it seems to be somewhat of a break even. And then when you sell short, you get the proceeds from the sell that goes into your interest income account. So I've been quoted as saying this is like the greatest thing of all time. You declare a dividend, the stock goes down, you have to pay it back to the person you borrowed it from. Okay. All of that money that you sell, when you sell the stock, it goes into your interest account. You're earning interest on it. And the borrowing fees are the short fees are kind of low, 10 basis points, 20 basis points. So, yeah. And once again, I think more than likely, I'm not an expert in this field, there is some of these costs embedded in shorting the S&P. Maybe not, but it seems to me that I don't know, as they arb the S&P against the outrights, more than likely you're being impacted by the reality of those stocks that are being sold. You're selling an index, futures index, but it's probably tethered to reality of selling those individual stocks short.
Also, too, on the single stock back testing topic, the big problem I see is in selecting the portfolio to back test with, being that if you do a really long back test and you pick stocks that exist now, you got that survivorship bias. I was wondering if you do anything like create not a portfolio, but a universe of potential stocks, and then have the back test select a certain number of them at random. So you maybe get some of those stocks that went away or disappeared, went out of business, got taken over, to try to get a realistic picture of what the back test looks like in the single stocks.
Right. I think you definitely want to do that. You definitely want to get a realistic view on how those stocks have done. Now, a lot of the stocks that I trade, if you look at my portfolio, they have very long histories, longer than the futures markets. And it's shocking how many companies, big ones and medium-sized, small, that have been around for such a long time. But one of the things too I would want to do that's going to kind of minimize this issue, even though I wouldn't seek to minimize the issue, I would do the research in the correct way, the right way, which is to fill in those holes of missing companies. But one of the things that I think is a good trend follower, you don't want to lose focus. You want to choose these systems that you're going to trade. Number one, you're going to trade them all the same system on all the markets. Number two is you want to choose these systems looking at all the data, not just the stock data. So I'm going to backtest the stock data. I think I've got some missing companies, all the missing companies. I'm going to do a legitimate backtest here. I've got all the corporate actions all figured out. And then, but still, I'm not going to choose systems. I'm not going to choose stock only systems, right? I'm not going to do that. And then we're not going to let the stocks dictate how we trade currencies, commodities, and interest rates. No, we're going to put all these markets, all the stocks, all the commodities, currencies, and bonds into the back test. And then we don't want to overweight any of the sectors for this back test. And then we're going to see what works best on all the markets. We don't agree that all markets are kind of different. They all have different personalities. Stocks are different. Everyone knows stocks are different. No, we don't agree with that. So we're going to choose the system, which is the goal here. What is the goal of this back test? It is singularly to choose the systems we're going to trade going forward. And I like looking at the trade stats primarily in order to choose my systems. I'll take a little look and gander at how the equity curve went up and down, and my rates of return, and my big drawdowns, and my Sharpe ratio. That's all based upon those equity stats of adding all those markets together, the performance of all those markets on a daily basis. I'll take a look at that, but I'm not going to base my decision on which stocks to trade. Which systems to trade on so much on this equity curve backtest, which most everyone does. I would not do that. So I'm looking at the juiciness of my bets, my expectation per trade, my average win, average loss, and my winning percentage. Now, so I'm saying all of this, but that's not the punchline, because I want to say it all because I don't want to minimize the question and the seriousness of it. However, I all markets make the same amount of money. All markets have the same expectation. Okay, so then I got to thinking about these two issues, and I called up someone who talks about this all the time, and is the person that I know best because he talks about it so much. And I'm sure there's got to be other people who take it as seriously as he does, as Eric, I'm talking about, is about this back testing of stocks. Because he talks about the data, how hard it is, no one does it right, and these missing stocks from stock. Okay, so I asked him this question, and I've tweeted this, because usually when I ask Eric a question, I get this incredible response back. And I ask him, can I tweet that? And I can attribute it to him if he wants me to. I can paraphrase it, or I can not attribute it to him. But sometimes he can just turn a phrase so amazing. And I've just never heard it put a certain way. And he has a way of doing that. And so in this case, I ask him, I'm like, have you ever done a back test on all of this only on the stocks that no longer exist? Yeah. Have you ever done a back test on those stocks only to see the trade stats of those stocks? And he said, yes, I have. And I said, what was your result? And he said, the result was they make about the same amount of money as the stocks that are still in existence. Of course they do. Of course they do. Because we know before we do the back test that the expectation per trade is the same in every market. Well, theoretically, that's true. It's not going to be practically true. But if you start gathering enough data, it even shows up in the data, which is kind of helpful, right? To have that opinion, and you just kind of want it to show up a bit in the data. So I feel like that we have a better way of handling this and looking at these markets with this trend following strategy and with our philosophical approach to what we think about the markets, and which I've just laid out. So, Steph, did I convince you?
Yeah, I love to hear that about Eric testing the stocks that went out of business and going out, that still made money. It reminded me, I had forgotten about this, but back in 2020, I was doing some testing with the Maritzes on crypto data, and Maritz Hyde had sent me. We were trying to figure out, what happens if you test on cryptos that have basically gone bust. And I remember doing a long only trend following test on on 50 crypto markets, 50 tokens, whatever you want to call them, that had basically gone to zero. And a long only trend following system in those still made money. I mean, it wasn't great, but it was a positive return over time. So it's cool to hear that with stocks too. I haven't done a lot of stock data testing, so
I think a lot of it's just going to depend on, did those ones that went out of business have any, how long were they around, and did they have the opportunity to have any big uptrends? If you're sort of testing a bunch of stocks that have short histories and didn't really ever do anything except go down or predominantly go down, then we kind of know too that the shorts are not going to be as good as the longs. But probably one of the greatest trades of all time, trend following trades, was Enron, long and short. Um, and then now Enron doesn't exist. Ho hum, who cares, right? And this is kind of the difference between buy and hold. So you sit there and you own these stocks for 100 years, and you watch them go up and down. And at the end of the day, according to the research that Eric did as well, and other people have duplicated, 4% of those stocks make all the money, or 4% beat treasuries, or something like that. So by doing nothing and just watching and crossing your fingers, if you have enough stocks and you have enough time, about 4% are going to, from over 100-year period or whatever, are going to produce all of this profit. Where if you just now take a look at these same stock charts and look and see all of the uptrends and downtrends, and the choppy periods and the losing periods, but look at all of the big trends, hundreds of ATRs on the upside, and then it's one of those 96% that from start to finish, it didn't really do anything. But in between the start to finish, those 100 years, and you're following all those trends, I mean, hell, what has cocoa done since day one? What is it going to do when the world ends? The whole history of cocoa, or the yen, or any of these markets, or crude. Where is it going to be? I don't know, but I know that in that intervening period, there's probably going to be, and there has been, a bunch of trends in those markets, and that's all I'm setting out to do, is to capture those trends. It's so irrelevant as to where did it start, where is it now? Oh, you can make money buying and holding it. It's such a silly concept, especially talking to it amongst trend followers, where it doesn't make any sense at all. We're monitoring these trends. We don't really give a crap what's going to happen in the fundamentals or finding the right stocks. It's just a numbers game of putting together as many markets as you can in your portfolio. Like, I was telling this to my wife, and I was telling her some other ideas I had about trading, and they were getting kind of crazy. And she was like, "This is just some game y'all are playing. This has nothing to do with anything except some game." I'm like, "Yeah, it's just a game. It's just pretend. There's nothing to do with reality. We need to divorce ourselves from all reality, because that muddies up our clarity as to what works when you're using systematic trend."
So one of the things is, there's a lot of emotion when people are talking about markets, companies, stock, investing, making money, losing money. And and actually there, it's a lot of unnecessary jargon. So, someone else, like, I'm putting this trading program on my own, okay? So I'm coding. At the end of the day, I'm talking about Time series data. So a stock Enron exists or doesn't exist. Who cares? It is a time series data. So everything else that I'm talking about, when I talk about trend following markets, the stocks, the companies, the making money, the economy and whatnot, is time series data. Time series data has certain properties. It is, first of all, time series data. It is data. It is data, and then this data has been compiled in a time series way. So it starts like 50 years ago and it comes to today. And this time series data has certain properties. We call it trend following, but it's such a high level, acronym to say trend following. So trend following means that, so first of all, we're talking about time series data, and then this time series data has correlation in it. People call serial correlation, but serial correlation makes it complicated. So I simplify saying there's correlation. So there's a concept of correlation. Okay, so what else? Then there's momentum. Momentum means that things that goes high continue to go high, or things that go low continue to go low. So there is time series data, there is correlation, and there is momentum. So this is genuinely what we are talking about. And when Jerry Parker talks about Eric Crittenden and his beautiful stock database, and that's very good to be able to put that database together is a lot of work. Okay, but at the end of the day, it's data science. So what Jerry Parker, when he talks about Eric Crittenden, what I hear is Eric Crittenden has done a lot of work in terms of data science, time series data, and a lot of people don't do a lot of work with time series data and data science. So what is your data science process? What are you doing? I've spent years to be able to have a proper database. Can you imagine? I do have a 1-minute database, 5-minute database, hourly database, and to be able to do that sort of intraday trading, the amount of work required to be able to work with the time series data. So it is correlation, it is momentum. Trend following is such a high level jargon. So really, the question becomes, how are you dealing with the time series data? When Seth talks about the back tests, the companies, the survivorship bias. So it all comes down to robustness tests. So the robustness tests of the robustness of your parameters while engaging with the time series data is a different question than how much return you're capturing. So return is another question, whether your parameter set, and the way it engages with this time series data, whether it provides statistically significant results over across the decades when you test this data in various in various single name stocks. So the way I am doing it is like Jerry Parker does. So I test my parameter set in all sorts of single name stocks. So I don't only test it with what I am running, but I am just testing it, all the European data that I have, all the US data that I have, all the stocks that I trade or I don't trade. And the more I trade about stocks and the markets, again, that point disappears. It's all about time series data. How strong is your data science properties, and that's very important. How, the correlation, the momentum, it all becomes trend following. But at the end, do you have a proper database? You cannot trade crypto without having a proper crypto database. You cannot trade single name stocks as good as Eric Crittenden without going through the hassles of putting that database together. And Eric Crittenden explains it in various podcasts, all the necessary steps to be able to put that database together. And of course, he talks about daily bars, and I am grateful to, data providers like, Richard is listening, Norgate Data, CSI Data, these are very important data providers when it comes to data bars. But when it comes to minute bars, oh my God, the work that they have done hasn't been done on a minute bar basis. So it becomes extra complicated, time consuming, and frustrating to be able to deal with the events that people already solved some of the problems, because it's all about problem. There's time series data, but then if you take even a step back, okay, so it's a problem solving exercise. Now, and it becomes really, I'm completely detaching myself from the problem. But the more problems solved, the less return possibilities are there sometimes. Okay, so overcrowding impacts. And one of the things about trading minute bars like I do, like from 15-minute bars to 1400-minute bars. 1400-minute bars is data bars. Okay, so what I'm doing is, the way I approach the time series data is, I'm saying trading data bars is a filter. So I am deconstructing that data bar into 5 minute components. So actually I can use even less filter in my own trading, but there are costs associated with it. And in backtesting and whatnot, it all comes to time series data. So there's a huge data science component to it, and when people are talking about it, we all get emotional. The stocks, the market, the money, you're making it, you're losing it. But the fundamentals, at the end, you have to love dealing with time series data. So it all starts from there. Thanks.
Thanks for that, Al. I can't help but end on this kind of funny statement that, with all that being true, I would say that if you had Eli Lilly in your trend following stock portfolio, and depending upon how many stocks you trade, if it's in there, and you get that 500 ATRs in this current trade, you're going to be pretty happy, and you're going to look pretty special, even if you didn't do the back test correct. And I guess to some degree, I don't really agree with that intensity of some of those things you were talking about, because you didn't really answer my, and we could do this next week, but really you didn't really. There's just two ways of looking at it. I agree with doing the back test properly, and I agree that it takes a lot of work. Although, on the other hand, I already stated that we're going to trade these stocks the same way we trade all the currencies, commodities, and interest rates. Yeah, and I would just sum it up by saying I'd be perfectly fine to not do any research on the equities and just say I have no ability to do the research on the equities. If this was the case, I'd be perfectly fine with that and just use the same systems that I've used on my exhaustive back test on the futures markets. Yeah, because I'm going to do the same thing anyway. So it becomes like, with 25% in the back test of my exposure allocated to stocks, how much is the stocks going to be? Are there parameters, trend following parameters, that are going to optimize the stocks better than the other 75% of the market's parameters that have worked the best on that 75%? And that, if the answer is yes, then one of my core tenets that all markets have the same expectation is incorrect. So to be really intense about this data and to think it's the be all end all, you have to, all markets don't have the same expectation. Stocks are in fact different. You may want to trade the stocks differently from all the other markets, on and on, things that I would not ever do and don't believe in. And I don't think fortunately, my back test does not confirm that. So I think it's another issue where I really want to listen to all of this data science stuff, but I don't think it really plays out in reality. In my reality, these breakout systems that work great in the futures work great in the stocks. And I'm going to choose how to trade the stocks based upon mostly how I trade the futures and what works best in the futures. Oh, I mean, it's such a bummer to end on, but we can pick it up next week. Okay. Thanks everybody for being here. Have a good weekend. See you next Friday.